Yeah, I mean, I think for the world of institutional investing, if you just look at it, most institutional investors these days put about half of their capital into alternatives. And there's a lot of good reasons why they do that. Combination of, higher risk-adjusted returns, greater diversification, and really access to outcomes that wouldn't otherwise be available, to just purely in the public markets. And so I think when you think about that space, the real advantage that hedge funds bring is the ability to tactically move, long and short between assets. That's something that a lot of different strategies, whether you're passively invested in stocks or bonds or, more structural long alternative assets like private equity and venture capital, you don't have that opportunity to navigate and switch your positioning depending on the market. Now, in general, being long assets and being invested is the right strategy to do in general over time. So it's not to say you want to, put all your money into a long and short strategy, but there are certain times when those strategies can be complementary to an overall portfolio being long assets. And that's really what hedge funds bring to the table, is that ability to bring, using long and short positions in liquid markets, to be able to bring that agility to your portfolio that you otherwise wouldn't be able to do. And frankly, part of the reason why they're so successful is they're able to hire some of the smartest minds in the world to be able to generate that alpha, to generate those strategies, and are essentially hired to do that by institutional investors. And the outcome is, as you say, which is that institutional investors, in part because of their allocations to things like hedge funds, typically experience meaningfully better risk-adjusted returns than the everyday investor.
Yeah. Talk a little bit about just how hedge funds work. We've talked about this in previous episodes, but it hasn't been the primary focus for us, just because it does kind of seem, set aside for the big investors and not as accessible to more everyday retail, credit type investors. But talk about the idea of long and short, right? Because if you're investing in real estate, you're buying an asset, you are inherently in a long position, meaning you're bullish on the future value of that being higher than it is now for whatever reason. But in hedge funds, you're generally trading in public markets, liquid markets, and you can create hedges with different positions, long versus short, betting on different things going on. Let's talk about where that kind of fits in a portfolio from your perspective, and explain what that means a little bit more.
Yeah, I mean, most hedge fund strategies are typically taking, are trading some of the largest liquid markets in the world. So, things that you see covered regularly on CNBC: stocks, bonds, currencies, commodities, fixed income, credit, etc. So, maybe 100 or 200 of the world's largest liquid markets. And one of the nice things about typical hedge fund structures is that they have the flexibility to go long and short. So, they're, in general, as an example, you want to be long stocks because there's good reason to believe that stocks will go up over time, say, relative to holding your money in the bank in cash. But there are certain macroeconomic circumstances where stocks go down. And I think one of the challenges for many long-only investors, and really the challenges for any passive investor, is that if you're just simply staying long through time, you can experience meaningful drawdowns. For instance, in stocks, you can experience 60, 70% drawdowns in your equity market portfolio. And so what hedge funds are really focused on doing in general is trying to identify those circumstances where, one or many of those major asset classes have pressures on them to either go, up or down more substantially than what's expected in the market, and then build a portfolio of trades, which are really just bets on those markets. And so one of the benefits of being in a hedge fund structure is that flexibility, going long, going short, not being locked into a particular view, and being able to respond to what is likely to occur in the macroeconomy.